The accounting treatment, both the balance sheet and the income statement accounting treatment for debt investments or bond investments, depends on the company's classification of those investments. Companies classify each and every one of their debt investments, debt or bond investment, into one of three categories that were established by GAAP. And these categories are based on what do you plan to do with this investment? Do you plan to hold it until it matures? Are you going to be actively trading it? Or are you not really sure how long you're going to hold it and when you're going to sell it? So we're going to write out what is the category called? What do we do with unrealized holding gains and losses? Because if we're going to report an investment at fair value, we're going to have unrealized gains and losses each time the fair value changes. What are we going to report the investment at on the balance sheet? And what's going to happen on the income statement? What will we report related to the debt investment on the income statement? Okay, so one category is called held to maturity. Typically, we abbreviate this as HTM. And the company, under the held to maturity classification, the company has the intent and ability to hold the investment until it matures. So think about this. You're the buyer of a 20-year bond. You have purchased this bond because you want to get those interest payments. This rate makes it worth it to you. You're going to hold it for the entire 20 years. You're going to get that consistent fixed amount of interest twice a year for 20 years. Does it really matter if the price of the bond, if you were to sell it, if the price changes, if you know you're not going to sell it? And that's the principle behind this held to maturity category. These changes in fair values, they produce unrealized holding gains and losses. They're ignored. They don't matter. We don't do anything with them because we don't report the held to maturity debt investments at fair value. We completely ignore fair value. The balance sheet, these asset investments are reported at amortized cost, which again is the initial debt investment minus any discount or plus any premium. And on the income statement, again, all we're going to see is interest revenue. We're not going to see any changes in fair values going through income. We will see a gain or loss if it's sold. And I know what you're thinking. Wait, if we're holding it to maturity, we're not selling. So we're saying, like, in that rare instance that, and typically it's very, very close to maturity, that we do decide. Obviously, if you're continually selling your held to maturity investments, the auditors, you're a publicly traded company, the auditors are going to say, what are you doing? This doesn't make sense that you're classifying it this way. So let's assume this would be kind of a one-off event. All right, makes sense, right? Now there's other categories. This is category one. Remember, we said 3 different categories. The next, another category is trading. If we classify investments in bonds or debt investments, if we classify them as trading, it means that the holder is planning to actively sell these things. Oftentimes in the real world, this category is going to be used by banks, financial institutions, where they're actively, like within the day, within a couple of days, going to be buying, selling based on how market prices move, and trying to capture that gain on the sale rather than sitting and holding them for those interest payments. Now, when we actually do examples, we're not going to be looking at sales within 1 day or within a couple of days. We're going to exaggerate that holding period. But we are going to show that those unrealized gains and losses, if you're actively trading them, we do want to see what are those fair values of these investments that you plan to sell very soon. So the unrealized holding gains or losses are recognized in net income. And while we're tracking, for the period of time that you're holding them, you are recording the interest revenue. If you hold it long enough, get the cash, record the interest revenue, amortize those discount or premiums. So we are tracking the amortized cost, but on the balance sheet, we're reporting these investments at fair value. So we would say trading investments are reported at fair value on the balance sheet, with those unrealized holding gains and losses reported in net income. What we'll see in net income is both the interest revenue, of course, always, and we're also going to see the changes in the unrealized holding gains and losses. And of course, once we sell this item, we're going to also recognize in the income statement the gain or loss on sale. All right, so we're either going to hold them, we're going to trade them. You're probably thinking, how could there be 3? What else can you do besides hold them to maturity or trade them? Well, this is like we're actively planning on selling them. This is we're definitely going to hold it forever. Then there's this middle ground, which we just call available for sale, where the company is not really sure. I might hold this to maturity, but if the prices are moving in our favor, I might sell it. If we need the cash, we might sell them. We're not really sure. So that's, again, why we're going to see really the trading classification is generally used only by banks, financial institutions. For companies like Apple that have these debt investments, it's either going to be hold it to maturity or available for sale. And most companies are going to report them in this available for sale category. And this is really just neither of the other two. Don't you love when something's defined at what it is not instead of what it is? Okay, and then this accounting treatment, unrealized gains and losses are recognized, but not in net income. Otherwise, we would just have 2 classifications. And you know GAAP is never that simple. Recognized, but not in net income. So what's that account that we use when we don't want something going into income, but we do want unrealized gains and losses going to investors somewhere, just not in income? Think of it as, let's say there were some classes that you could take where your grades in those classes would never go into your GPA. An employer would have to look at some other piece of paper in order to find out what were your grades in those classes. We call that other comprehensive income. It's just a place, an account to put unrealized gains and losses that we don't want to go onto the income statement, because investors care so much about, they put so much weight on net income, just like students and employers put so much weight on that GPA. So they're recognized in other comprehensive income, which is reported on the statement of comprehensive income. I'm writing that down because we don't talk about other comprehensive income very often. On the balance sheet, they're going to be reported at fair value. And then what will we see on the income statement? Of course, interest revenue, always, regardless of the classification. We're not going to see unrealized holding gains and losses because they're not going to be in net income. They're going to be in the statement of comprehensive income. We'll also see gains and losses, gain or loss